The big question that everyone asking is why isn't the Chinese Communist Party doing more to support the economy right now? And so the big take really tries to address that question. And what we see is we need to understand the sort of long-term ambitions of Xi Jinping here. He wants to clean up off-balance sheet debt. He wants to shift away from debt-fueled growth and the risk that creates at the local government level. And he wants to fix his problem of oversupply and a potential market bubble popping in the property sector. And these fundamental goals are not just sort of in tension with this downward spiral and that flailing that you say now, but actually have caused that. And when we understand that, we understand the extent to which Xi Jinping and the party have already exhibited this extraordinary tolerance for pain, because this is part of a campaign, as they see, to really clean up risks in China's economy long term. And some amount of short-term pain is going to be inevitable in that process.
I think somebody called it an expectation recession, didn't they?
Yeah, it's a really interesting idea that if you essentially sort of are convinced that there is going to be some kind of slowdown, you get this vicious cycle, this downward spiral where people feel poorer. Prophecy. Absolutely, yeah. They don't want to spend. And if you look at property, you can easily see why. 70% of household wealth, your most sort of valuable household asset that you have, is going down 10%, 50%, 20% in value in some prime locations in major cities in China. Of course, naturally, you feel poorer, you don't want to open up a new business, you don't want to expand your current company. You can see why this is so worrying and why this confidence trap is such a risk.
And why, we've talked about a lot, I guess, about this. This is not a cyclical story. It's a structural one, as you're laying out. But then you're seeing there's a bit of a media blitz, as you said, over the weekend of at least some urgency from policymakers to at least meet with the banks, meet with the stock exchanges to try to stabilize the markets in the short term.
Yeah, absolutely. And I think it's that question that we talked about earlier. Can China buy itself enough time to actually let these policies, these quite painful long-term policies, actually ride out? Yeah. Can they stabilize the markets just enough? Can they prevent that contagion risk in the shadow banking sector just enough to allow them to do these other things that, longer term will potentially make the Chinese economy much more sustainable and much more robust? But there is that risk, and I think you're right that we see this greater urgency in this increased messaging and this sort of increased flurry of meetings as well.
Since this is many years in the making, I would imagine they anticipated the potential pains we're feeling now. Yeah. I mean, can investors trust that they managed to prevent a crisis while they sort of fix the structural issues on debt?
My colleague in Bloomberg Economics, Choong Wilkins, would put this as the bubble never pops, that the party always manages to find a way to muddle on. And I think the other element here is not just that they've shown this sort of tolerance for pain in rolling out these sort of policies, but not just that, but we also always have this surprise factor. Think back to when they lifted those COVID restrictions. No one was anticipating that we would see that very sudden lift, right? Everyone said it's going to be gradual, we're going to see this slow trickle up of lifting, and we saw something totally different. And I think that element, that wildcard element, is always going to be there. No one's betting on stimulus or huge stimulus, but there's always that potential for surprise policy move when it comes to China.